Welcome, everybody. It is September 18th, 2025, and this is WWM Talks. I'm here with Greg Carroll and Vince Stefano. You may notice there are no women here today. They are off learning more about life and sales and everything. I can't wait to have them back next week. At any rate, let's see what happens what happened over the last week. The S&P 500 was up about 1.6%. The Nasdaq was up about 2%, and the Dow Jones Industrial Average was up about 1%. Interestingly, the performance of the small caps were up a little bit, but not as much, at 0.3%. So Vince's going to tell us a little bit more about how stocks have done in a longer time frame.
I'm going to take you right through the year-to-date September 17, which was yesterday, for all of you who want to know. Anyway, NASDAQ up 15.3%. S&P 500 up 12.2%. Dow up 8.2%, and the Russell 2000 up 8%. And a couple of podcasts ago, I remember we went around this table, and I said, where do you think the S&P is going to be at the end of the year? And we all had our bets. Well, let's see how close we can get.
I said I had no idea.
I know that, but I'm going to have to have Jocelyn go back.
I forgot what I said.
It's on tape, so we'll find out. Anyway, Powell cuts rates yesterday, 25 basis points. Market, was up and down. It looked like a little yo-yo, but that always happens on the first day of a rate cut. And when you look at the chance of continued rate cuts, the October meeting, it looks like there could be a 90% chance of another quarter point. And in December, an 83% chance. So again, we've been talking about the underperformance of some of the small cap stocks. And we've said all along, interest rates need to come down 1.5% to 2%, get money cheap, get these small cap stocks be able to borrow money a lot cheaper, and I think they'll do quite well. A couple of comments from Powell, and I think they were just little.
This is the Federal Reserve.
Yeah, this
chairman.
Federal Board chair. He was talking about, he was monitoring financial stability in the country, and he was saying that American households and banks, on an aggregate basis, both look like they're in very good shape. He has no view on asset prices. And so he said, I don't know if the markets are at the right or wrong levels. So that he doesn't comment on that. He said structural vulnerabilities, he doesn't see any across the spectrum, so that's good. The Fed doesn't cut mortgage rates, but he did say that their policies will affect them to the up or the downside. And the only thing he mentioned about tariffs was that they're currently being paid by companies that sit between the exporter and the consumer. So he's not seeing that much price increases pass on. And if he does, they're very, very small. So again, those were kind of his comments. And if anybody has anything to say.
Well, I think along that line is, they haven't passed on that many yet, but it sounds like a lot of companies are talking about beginning to pass on more as we progress through this new tariff environment. Where are they going to land? Because they're up and down.
Well, one of the things Jerome Powell has said in the past is that this inflation is a one-time thing.
Right.
So it's not persistent.
It's a one-time bump in prices.
Right. So I'm a little surprised, even with his comments, that he didn't go more than a quarter of a point.
Well, he's been late to the party
Well,
for a while.
He's got two mandates. He's got stable prices and stable employment. And clearly the employment side is where the weakness is. And so they have certain things they can do to support that, like lower rates. But when you got inflation starting to, maybe percolate a little bit again, as they've been coming down for the last, year or so, that takes different, measures by the Fed. So they're kind of balancing. And what he called the quarter point an insurance cut, which tells me, my impression is, even though the odds are that we lowered in October and December, I think what he's saying is that's maybe not the case if these prices keep going up.
Yeah, but there were a lot of Fed governors who wanted 50 basis points yesterday and then continue on more cuts this year. So
there was one who wanted 6 cuts, so it would have been 1.5 points.
Well, he joined the Fed this week, right?
Yeah.
I think it was 5 is what he wanted, but Yeah, that's a lot.
5 or 6. It's a lot of cuts.
Nobody had more than 2, right?
But going back
Besides
to
him?
the small stocks that you talked about, this is the lowering of interest rates is really good for small stocks. Partly because they do almost all their business here in the United States, and also it makes it easier for them to borrow money. And the large companies, it's not that big of a deal. They can afford to pay a little bit higher prices, but small companies are really affected by.
Well,
by
they have a
those
lot
markets.
of debt compared to the big companies that can fund all their business through the cash flow that they're generating, like Vince always talks about, earnings and cash flows. So the little companies, a lot more debt. This gives them more flexibility.
Right. So speaking of the CNN Fear and Greed Index, I know you guys are dying to find out where we're at. In the last couple of weeks, we're squarely in the middle, in the 50s. This week, we're at 62, which actually is kind of the low-mid range of greed. Okay.
Low mid-range. Okay.
So, yeah, because the range goes from 55 to 75, and it's at 62. So it's really kind of in the middle.
Okay.
But again, it's up from where it was. A month ago, we were at extreme, and I'm saying maybe it was 2 or 3 months ago, we were at extreme greed. Right. And then it came down to neutral, and now we're back to greed again. So it tells me something about the psyche, too, of the investor out there.
Yeah, and I think right now, when you look at where the investor psyche is, I think the investor psyche right now, they love risk. And the investors, and we all know risk is a two-edged sword.
It's a four-letter word.
It's a four-letter, yeah, well, to a lot of investors it is. But you have to realize that since, and I know, Greg, you've mentioned this a lot in podcasts, since, mid-April? I mean, the market has been pretty much straight up.
Right.
And the path of least resistance right now, I think, continues to be up because money on any dip, investors keep pushing money into technology stocks. And they're adding to their holdings. And this is, I'm going to make a comment here, and you guys can touch on this and add your thoughts. But, investors keep buying the dip. They keep adding to their stock holdings, whether it's through individual stocks, ETFs, mutual funds, and they're thinking that they're getting diversified. I'm going to make a statement that maybe they're not, because you look at the composition of some of these ETFs and mutual funds, and you see a tremendous amount of overlap because a lot of these stocks or these these market proxy investments are concentrated in the same handful of names, and it's predominantly AI themed. So the caveat is, as groupthink sees these stocks to continually go up, be very, very careful. And I'm going to quote Warren Buffett, and I got to make sure I quote this correctly. Warren Buffett says, and it's about diversification, he said, if a man has a harem of 50 to 60 women, you never get to know any of them quite well. So my thought to the investor is, as the markets continue to hit new highs, know what you own, but more importantly, why do you own it?
And along that line, about knowing what you own in mutual funds and ETFs, I was looking at some emerging market funds, which are not developed markets like the U.S. and Europe. This would be, like South America, even China.
Vietnam, those kind of places.
So we were looking at 3 of these funds, and one of them dramatically has been outperforming the last 2-3 years. And so I did a deeper dive. I look at the top holdings, and in one of them, the top holding is the largest company on the planet, which is a U.S. company.
And it's in an emerging market.
And it's a top holding. So you know where the performance is coming from. The outperformance is because, and they loosely, some of these funds, because they might do a little business in an island like Taiwan, it's an emerging market, company, so to speak.
Well, they can make up their own definition of what emerging markets are.
It gets a little washy in there. So you need to, like Vince, you got to know what you own. If you have a fund or an ETF, look at what's in there, because if you had 10 ETFs or 10 funds, and they're all going up crazily right now, they probably have very similar holdings, so you have all that overlap. You're not diversified. You just buy one of them. Yeah. So.
Yeah, and it's interesting too. You talk about buying dips and all that kind of stuff. It's interesting that there are a lot of people out there, and some of our clients, who think that when a stock goes down, its dividend goes down also. When we do a dividend income portfolio where the objective really is more about dividends growing. But, it's for those people who maybe aren't quite grasping what happens with dividends. Dividends go up because of the growth of revenues in a company. Their earnings go up. Okay, the stock price is just a point in time that says this is what the public is willing to pay for one share of that ownership of stock. And it really has almost nothing to do with the dividend. So for those people who want income from stocks and a little bit of growth from them, you got to remember that the dividends do not go down just because the stock price goes down. And the reason I say this is because I think, Greg, we talked about this a little earlier today, that in April, stocks went down by more than 20%, which is the definition of a bear market.
Yes.
And there were some people who say, well, my dividends are going to go down. Well, no, that's not what happens.
And those stocks, because of the dividend, probably didn't go down 20% like the rest of the market.
Well, probably not, but
in general.
Yeah, if you hold it for the year, let's say,
right,
and you're getting dividends, it certainly offsets some of the downward move of the price. But the price is not the earnings.
Right.
The price is not the dividend. The price is simply what people are willing to pay on that particular day and that particular moment for a share of that stock.
Yeah. Dividends just sharing the profits with the owners, which are the stockholders.
Right. And if a company continues to have more and more earnings, eventually the stock will go up. And if its earnings are getting worse and worse, eventually that stock will go down. But we focus so much on day to day and even week to week, which I really don't like to do, but since we're on weekly, we give an update. But you really need to look at long term, which brings you to another question.
What is long term?
Well, for me, it's 3 to 5 years or more. Okay, long term for some people could be 6 months, but I don't think that's really long term. I think you have to give a company room to grow.
Yeah, I had a client once. I kept talking to her about long term, and okay, we're going to hold this long term. And usually it didn't take a month.
Right.
It's like, wow, come on.
So speaking of longer terms, President Trump recently said that he would like to see the earnings reports for these public companies come out once every 6 months instead of once every 3 months. What do you guys think about that?
I like quarterly reports. I think it allows the portfolio managers like myself to really focus on where a company is. They do give guidance 6 months, a year out, sometimes 2 years out. But I really like to hear quarterly reports. One of the reasons I think Trump was talking about 6 months, quarterly reports are expensive. And, for a company to constantly, you got to put out, there's a lot of money involved in putting out quarterly reports. Yeah. So if you can do it every 6 months, you save some money. And the second part of that is there are a lot of private companies that don't want to go public because they don't want to report quarterly earnings. So maybe every 6 months they would decide to come public. I don't know. Well, I want to stay at quarterly.
Well, plus the liability that they have when you're a public company is much greater than when you're a private company.
And I think when you force we talk about long term, but quarterly reports, the downside of those is you force the company to look short term and not just long term.
Because they want to meet metrics.
They got to meet a metric every 3 months, and so that's the downside of quarterly reporting. Not to mention the costs and all of that, but there are reasons to that maybe they're trying to meet these short term hurdles all the time, and it prevents them from implementing and getting to those longer term goals quicker. In my point of view.
Right, but I think the longer term goals are really what you're after.
That's what you're after because you're holding 3 to 5 years minimum.
Well, you hope.
You hope.
All right. What else? Anything else going on, guys? All right. Well, we will have I believe both Rachel and Catherine will be here next week. They were missed. In the meantime, this again is September 18th. We will see you guys on hopefully the 25th of September. Until then, have a great week of investing, and we'll talk to you
next week, guys. Ryder Cup.
Well, okay. Until next week, we'll talk about the Ryder Cup. In the meantime, have a great week investing. Talk to you soon. Bye-bye.
Bye now.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.